Hey, welcome to the Profit Builder video series. I'm Vicki Suter, your host, and I'm the author of the book, The Profit Bleed, How Managing Margin Can Save Your Contracting Business. And these videos are all about helping you grow a more sustainably successful contracting business. And for over 25 years, I've been helping contractors increase their profits, generate more time in their day, and reclaim and refine the joy in what they do again. And that's what this video series is all about. And my goal is to help give you the thinking to be able to understand how to do that in your business. And then I actually give you tools and resources that help you implement what it is the video is talking about. So I hope you enjoy today's Profit Builder video. In today's blog, I want to talk about balance sheets and how to use them as a powerful management tool within your business. And I had somebody recently come to me who said, I know that my balance sheet's important, but I don't necessarily know how to use it, and what am I supposed to look for? I actually get that question a lot from people. And so I thought it might be helpful to you too if I actually walked you through a balance sheet and how to read it and to explain really what it is and why do you want to look at it on a regular basis and how it can help you grow a more profitable and successful business. The balance sheet, first in definition, is simply a reflection of your company's value or net worth from the time that you opened the doors. So it accumulates all the profitability. It shows where did I spend my money, what kind of distributions did I take, what kind of assets did I buy with my profitability. Like, it kind of takes a culmination from the time that you started your business until today. What is the value, what is that net worth of your business today or at any point in time? And your balance sheet, I'm going to first explain sort of the different sections of your balance sheet. And then I want to explain what are a couple really important numbers that you want to look at every month or at least once a quarter that are a way for you to keep your finger on the pulse of the health of your company. The first section of a balance sheet is your assets. So your balance sheet basically has assets, liabilities, and equity. Assets are something that you own that has value. Liabilities is something that you owe, and equity is the difference between those two numbers or what you keep in your business. So there's different sections of assets. The first section is current assets. And current assets by definition simply means that those dollars are convertible to cash within the next 12 months. So things that show up under current assets are like checking accounts or accounts receivable, that kind of thing, loans receivable, anything like that. And then the next section is fixed assets. And fixed assets are just like what they sound. They're fixed in nature. They are things like equipment or tools or trucks that you purchased that are assets that you can use to help you run your business. And fixed assets usually are things that have a lifespan of more than 12 months, and they're depreciated over the life of those assets. And in this case, you'll see that this company has fixed assets with a value of $43,000. That's net of accumulated depreciation, which is, it gets depreciated over the life, right? And then there's other assets, which are, there's nothing on this statement to show numbers, but those are usually things that convert to cash after a 12-month period of time. So those might be loans receivable that have a longer receivable term than 12 months. And then we have the next section of your balance sheet, which is liabilities and equity. And liabilities and equity, liabilities, as I said, is money that you owe. In current liabilities, similar to current assets, current liabilities are money that you're going to owe within the next 12 months. So that would include things like accounts payable, credit cards, that kind of stuff. And then also under current liabilities are usually payroll tax liabilities and what have you. So that's current liabilities. And the next section is long-term liabilities. And long-term liabilities are what you'll owe in a period over 12 months. So that's usually vehicle loans or equipment loans, that kind of stuff. So that's assets and liabilities. The third section is equity. And this is where it reflects, what did I invest in my business originally? What kind of distributions have I taken out of the business? Either, in this case, it's got owner tax distributions. They separate that from profit distributions. And then also retained earnings and net income. And retained earnings is how much have I left in my business from prior year's profits. And then net income is what's my current net income for this year. And then the net of all of that is total equity. So this number represents the value or worth of your business. Now, you might look at this, and one of the things I always say is that numbers in and by themselves don't mean anything. So let's talk about what are some benchmarks that you would want to pay attention to, other than if you looked at total equity and you saw it was a negative number, then you could know that your business had a negative value. That's probably not good. But let me tell you about two other really key numbers that you want to pay attention to on your balance sheet that will really help you have a better sense of the health of your business, because the balance sheet is a reflection of the health of your company. So I'm going to go back up to the top here, and one of those numbers is something called a current ratio. And a current ratio is current assets divided by current liabilities. And that represents a number that tells you, in the next 12 months, am I bringing in, based on where I am today, am I bringing in more cash than what I owe, or is it the other way around? So let's look at these numbers here. In this example, current assets is $174,000. And if I scroll down, current liabilities is $18,000. And so what's the number that you want that to be? You want it to be at least a 2-to-1 ratio. Now you can see from this is like 9.28%. And I know there's not a percentage point there, but that's what that is. It's 9.28%. If I take the $174,000 and I divide it by the current liabilities of $18,782, that is 982 times more assets than liabilities, current assets versus current liabilities. So that's great. That's an indication that your business is cash healthy. And remember, the goal that you're going for is that you want this to be a 2-to-1 ratio. So a 2-to-1 ratio is what you're looking for. Twice as much current assets versus current liabilities. And I'm going to talk a little bit more in a second about why is that important, what are some other reasons that you want to have that. The most obvious reason is I want to make sure that I have more cash and more cash available to me in my business than I'm going to owe, for all the very obvious reasons. Otherwise, you end up having to borrow money to pay loans and pay debt and pay credit cards and payables and that kind of stuff. The other reason is because it helps you be able to withstand a greater risk, should risk, and when risk, I should say, occurs, because we have risks as a business owner. But I'm going to go back and I'm going to talk about that in a second. But I just want to give you this calculation, and then let's talk about why these two numbers are important. So the current ratio is current assets divided by current liabilities. You want that to be at least a 2-to-1 ratio. Twice as much assets as liabilities. And now the second ratio is what's called a debt to equity ratio. And that ratio, you want it to be exactly the opposite. You want it to be that you have less than 2 times the amount of liability compared to equity. And in this case, this company has 0.331% liabilities to equity. So total liabilities here is $53,928, and total equity is $163,000. So roughly you have about 33%, 0.33% liabilities to equity. That's good. Those are good numbers. So our goal here, remember, this is to have this be less than a 2-to-1 ratio. And this current assets, you want this to be more than a 2-to-1 ratio. Now let's talk about why those numbers are important. So let me just make a general assessment about this balance sheet. First of all, it's a very healthy balance sheet. And these numbers are important for two key reasons. One is, in my experience, companies that have good current and debt to equity ratio, current ratios, they tend to be able to withstand risk more. And as an example, in 2008, when the crash came, in 2009, there were clients that I had said to them, you always want to keep in cash reserves. You always want to have these numbers be healthy. So our goal is to always strive for a 2-to-1 ratio on current assets to current liabilities, and less than that, 2-to-1 ratio on debt to equity. And the clients that I work with who did that, and who also had at least 3 to 6 months equal to cash reserves in their company, were able to withstand the hit as they had to reorganize their company and readjust to a different economy. They had the cash reserves built into their business that allowed them to withstand that hit that occurred. And it's a good rule of thumb, the 3 to 6 months equal to overhead. I didn't make that up. That's a general standard in business. That's a good practice to have. And if you just have that as a goal, the truth is you're almost always going to have a good current assets to current liability ratio. So think of it this way. Something can happen. We never know, right? We never know when those those times are going to occur, just like it did in 2008. When you get hit by something that you didn't expect. And so by having that money in reserves, you give yourself a safety net. And the other thing I notice is the clients that I work with who have that money in reserve usually have a lot more peace of mind in their business. So I encourage you that even if you start by building, maybe it's one payroll, then a month's payroll, and then work your way up to 3 months worth of overhead at least. And I guarantee you that you're going to find you're going to have more peace of mind just about cash flow in your company. One of the other reasons why this number is important and the debt to equity ratio is important is that if you go to get a line of credit with a bank is going to look at those two ratios. Those are two key numbers that they always look at when they're looking at lending a company money. They want to know that you have liquidity, and they want to know that you're not over leveraged with debt. So why an under 2-to-1 ratio on debt to equity is that it's an indication that a company that's more than that usually is highly leveraged with debt and is going to have a difficult time paying that debt off in a timely manner. So from a bank's point of view, they look at it like those are just indicators of the financial health of your company. And well, it's good to do it for the banks. What I have found is when you do it for you, when you make those two numbers a focus in your business where you really want to build a financially healthy company, I promise you it's going to give you more peace of mind about your day-to-day operations. And it's going to give you more options and choices too, because here's the interesting thing. Not only can you withstand more risk, you're not over leveraged, you don't have too much debt, but it's also going to allow you that if an opportunity shows up, you're going to have the resources to be able to invest in that opportunity. And it's also a way to make sure that there's money in your business that's going to allow you to expand and grow in those moments when you want to do that. So I hope this has been helpful to you. I am including with this post an article that I have about how to read your financial statements, and it actually explains these ratios in detail for you. So you can take that and actually go calculate those numbers in your business to see what your ratios are. I hope this has been helpful, and until next time, I wish you all the best. I hope you found today's video helpful. If you're ready to take your next step in your leadership journey and to build a great contracting business, I encourage you to check out my book, The Profit Bleed. It's full of great tools and resources that will help you implement the processes and the systems and the structure that will allow you to build a more profitable business, allow you to work less hours, and help you reclaim the joy and fun in your business and in your life again. And for a limited time, you can get my book for free. All you have to do is pay $7.95 shipping and handling. And you simply need to go to theprofitbleed.com/free. Thanks again for joining me for today, and I look forward to seeing you next time on The Profit Builder.